Most people don't lose money in markets because they pick bad investments. They lose money because they say yes too often. That might sound simple, but it's the core mistake behind almost every blown up account I've ever seen. People think investing is about intelligence. It's not. It's about restraint. The hardest skill in investing is not finding opportunities, it's ignoring them. Every single day there are thousands of things you can invest in. Public stock, crypto, private deals, funds, startups. Someone somewhere is always making money in something. And if you don't have any rules, everything looks tempting. Now, before you begin, for those of you that don't know me, my name is Taha. I've been deploying capital for many years now, and just to show you my past performance, as you can see right here, this is one of my accounts. It has today's date on it. This is my year-to-date percentage return. This is 6 months. Then we have 1 year. And then 2 years, as you can see, is a little bit lower because we liquidated a big chunk of capital around here. This is to show you two things. One, never expect consistency in the stock market. And two, I know what I'm talking about from experience. In this video, I'm not going to tell you what to buy. I'm not going to predict markets. I'm not going to talk about returns. I'm going to walk you through the rules I use to decide what I don't invest in, because that decision matters far more than what you say yes to. This is not advice, this is simply how I deploy my own capital. Most people think diversification means owning many things. What it usually means is unmanaged exposure. They own things they don't fully understand, they own things they can't explain, they own things they don't know how to exit, and they confuse activity with progress. If you're constantly adding positions, constantly tweaking, constantly reacting, that's not discipline. That's anxiety expressed through actions. Professionals don't win by finding more opportunities. They win by eliminating more opportunities faster. I don't ask, is this interesting? I ask, does this survive my filter? And if it doesn't, I don't debate it, I move on. Think of investing like a funnel. At the top of the funnel are thousands of ideas. At the bottom, there are very few actual investments. Most people invert this. They start with excitement and then look for justification. I try to do the opposite. I assume everything is a no and the opportunity has to earn its way to a yes. That mindset alone changes how you behave. You stop feeling like you're missing out and you start feeling like you're protecting capital. So let's go through these filters that I'm talking about. Rule number 1, time and attention are constraints. My first rule is about time, not returns, time. Capital is not my limiting factor. Attention is, energy is, focus is. So the first question I ask about any investment is simple. How much attention does this require to not blow up? If an investment only works when you're watching it constantly, that's not an investment. That's a job. That's day trading. That's a scam. Whatever you want to call it. There's nothing wrong with jobs, but I don't confuse them with my investments. This rule alone immediately removes a huge portion of opportunities. Short-term trades, high-leverage structures, things where one headline can wipe you out. That doesn't mean they're bad, it means they're bad for me. Your rules should match how you want to live. Rule number 2, define downside before upside. The second rule is about downside. Before I ask how much I can make, I ask how much I can lose and how fast. If I cannot clearly define the downside, I stop. I don't negotiate with it, I don't rationalize it, I move on. Every good investment has asymmetric risk. Limited downside, meaningful upside. Bad investment don't lack upside, they hide downside. If someone spends most of their explanation talking about potential gain, that's usually a warning sign. I don't need certainty, I need clarity. Now, rule number 3, great companies versus great investment. This is where most people get stuck. They find a great company and assume that automatically means it's a great investment. It doesn't. A great company at the wrong price can be a terrible investment. Most people stop their analysis at this is a good business. That's not enough. That's where professionals start. Price matters, expectations matter, timing matters. I ignore many incredible businesses because the terms are bad, not because the business is bad. This distinction alone saves more money than any stock pick. Rule number 4, expectations versus reality. The next rule is subtle, but it's where most losses actually come from. Markets do not reward growth. They reward growth relative to expectations. A company can grow, beat earnings, post strong numbers, and still go down. Why? Because the market already expected more. Most people don't invest in businesses, they invest in stories. And stories break when the reality doesn't exceed the narrative. So before I invest in anything, I ask a specific question. What does the market already believe? Not what I believe. What is already priced in? If I can clearly articulate that, I don't invest. Because then I'm guessing, and guessing is not a strategy. Alright, rule number 5. Why good news can still be bad. Price doesn't respond to news, it responds to surprise. That's why most people follow the buy the hype and sell the news strategy. If good news was already expected, it's not good news anymore. This is why I don't react to headlines. I react to deviation from expectation. Sometimes that means doing nothing, even when everyone else is excited. Doing nothing is uncomfortable, but discomfort is often the price of discipline. Rule number 6. Position size is the real bet. Most people think investing decisions are binary. Buy or sell. They're not. The real decision is size. Position size is how you express conviction, uncertainty, and risk. Two people can buy the same asset and have completely different outcome. Not because one was right and one was wrong, but because one sized it incorrectly. I would rather be right with a small position than wrong with a large one. If I feel emotional about a position, that's not a reason to size up. It's a warning to size down. Emotion is information, and in investing, it usually tells you when your risk is mispriced. Rule number 7, losing money versus making bad decisions. Losing money does not automatically mean you made a bad decision, and making money does not automatically mean you made a good one. Outcome does not equal the process. If you confuse the two, you will learn the wrong lessons. I judge decisions based on information available at the time, not hindsights. Some losses are the cost of doing business. Some wins are just luck. If you can separate those two, you'll overcorrect, and overcorrection destroys consistency. Rule number 8, cash is an active decision. Cash is a position. It's an active allocation choice. If nothing meets my criteria, I don't force capital into the market. I wait. Patience is not inactivity, it's delayed action. You don't get paid for activity, you get paid for judgment. Rule number 9, simplicity is a hard rule. If I can explain the thesis simply, I don't invest. Complexity is often used to mask uncertainty or to impress people. Neither protects the capital. Simple doesn't mean easy, it means clear. Clarity reduces error, and reducing error is how capital compounds. So why I ignore most opportunity? Ignoring opportunities is not weakness, it's the strategy. The goal is not to be involved in everything, the goal is to survive long enough for the few good decisions to matter. I'm not trying to be right all the time, I'm trying to make decisions that make sense, even when they don't work. That's the difference between investing and gambling. In future videos, I'll walk through real decisions before outcomes, and I'll review them honestly after. No hindsights, no excuses. If you care about how decisions are actually made under uncertainty, you'll enjoy what's coming.